Hello again. In this video, we are going to calculate the cost of goods sold under the LIFO cost flow assumption. So let's move into Excel to illustrate this practically. We are going to use the same units, the same exercise that we utilized when we are calculating this on the LIFO. Like I said, we are using perpetual inventory system, which means that we are constantly updating the inventory, right? The inventory is always updated in the books. And LIFO indicates that the last units that came into the warehouse are the ones we are selling. That's the assumption, right? Last in, first out. So let's start with our initial inventory of 40 speakers on June 1st. 40 speakers were in the warehouse, and the value of those speakers were $5 each, which makes $200 worth the inventory on June 1st. Now on the 10th, 30 speakers were sold on the 10th. We have to determine what the cost of goods, what is the cost of those speakers, those 30 speakers that were sold on the 10th. So we only have 40 in the warehouse, and they were cost of 5. Therefore, that's the cost of those 30 units. We're taking them out of the 40. Those 30 speakers came out of the 40 that were already in existence in the warehouse, in the inventory. And the cost of goods sold for those 30 units or 30 speakers is $150. Now let's update the inventory. The inventory now has 10 speakers, right? 40 minus 30 is 10. And the cost of them is 5. The next transaction is a purchase. On the 15th, we purchased 70 speakers, and the 70 speakers were purchased at $20 each. We have $1,400 worth of speakers from that purchase. Now let's update the inventory. Like I said before, the inventory has to be updated continually. The ending inventory is now 80. 10 plus 70, that's 80. However, we have 10 speakers at 5 and 70 at 20, and therefore we cannot put them together because the cost of them is different. So we're going to do special square here. So 10 at 5 makes up 10 speakers that were there in the warehouse, right? And 70 that just came in at 20. That's the ending inventory. 80 speakers at $1,450, $1,450. That's our ending inventory. If we are done with the exercise, we could say our ending inventory at the end of the month is for $1,450. But there's more, and that's on the 15th. On the 15th, our ending inventory is 80 speakers at $1,450. In the next transaction, there was a sale on the 20th. On the 20th, 50 speakers were sold. So we need to cost or determine what is the cost of those 50 speakers. Because remember, we have 80 in the warehouse that were cost at we purchased them at different prices. Therefore, we cannot say that the cost is any specific cost until we figure out which assumption we're using. In this case, it's LIFO, and for that reason, we know that the cost of the speakers we're selling now is going to be from the last speakers that were purchased. Let's break this down. 50 were sold, and we have 10 at 5 and 17 at 20 on the 15th of the month. Since we're using LIFO, we are getting those speakers out of the 70. So on the 20th, the cost of goods sold of the 50 speakers that were sold is going to be $20. So 50 multiplied by 20 is 1,000. The cost of those 50 speakers is 1,000. We had enough in the warehouse of the last purchase to get them all out of there. 50 out of the 70. In updating the inventory for the 20th of the month, we have to take into consideration the fact that 10 speakers were not sold. They are still in the warehouse. So we brought them down here in the books and to update the inventory, and we say, okay, we still have those 10 speakers that had been purchased at $5 each. However, out of the 70, we sold 50, which means we have 20 at $20 each from the 50 that were sold from the 70. So 20 are remaining from this batch. Our ending inventory is completed as of now, but we still have one more purchase or one more transaction. And by the way, this was on the 20th. Now on the 30th, a purchase of 100 units was done at $10 each, which makes up 1,000. Let's update the inventory. Let's see what's happening here. This is a very good exercise. This is a very good one because we have a very interesting situation where we still have the 10 speakers in the warehouse priced at 5. And by the way, let's back up a little bit. We have in total, in the warehouse, there are 10, 20, and 100 units, 130 units, 130 speakers, because we had 10 in the warehouse, 20, and we just purchased 100. In total, we have 130 speakers. The three of them, the 3 batches, are cost at different prices. That's why I find it very unique. Very good example. Therefore, we have to update the inventory accordingly. 10 at 5, 20 at 20, and 100 at 10. Which means that on the 30th, the final inventory is 130 units. And the value of that ending inventory is 1,450. $1,450 is the final inventory in this example. And the cost of goods sold or the cost of all those units that had been purchased is that had been sold, sorry, the cost of the unit, the speakers that had been sold in the month is $1,150. We sold 80 speakers in the month of June, and the cost of goods sold for those are $1,150. I am going to bring up the example we had done before with the FIFO with the intention of comparing the costs to see which cost is higher. Here is the FIFO here in this on top. This is the FIFO example, and here we have LIFO. When we calculated the cost of goods sold on the FIFO, the cost was $1,000. When the cost is lower, of course, the profit is higher. On the LIFO, the cost is higher. And it makes sense. If you think about it, when we use LIFO, we are purchasing goods at a higher price. The last ones in are usually purchased at a higher cost. Therefore, when we calculate the cost of goods sold under this cost flow assumption method, the cost is going to be higher than on the FIFO. On the FIFO, we are calculating the cost of goods sold based on earlier prices, units or products that were purchased at a lower cost because they were purchased earlier, and the costs of goods tend to increase over time. Therefore, when you use LIFO, we're using costs that are higher, and the cost of goods sold tend to be higher. That is the difference between the two when it comes to how these methods or these two cost flow assumptions impact the profits. And that's it for now.